We're now going to shift our focus from booking the transactions and figuring out the accounts to why are we doing this? What does this all mean? What is the purpose of doing this? And the answer is that we're going to create financial statements. We're going to start first with a simple income statement, statement of owner's equity, and balance sheet. And so, what is an income statement? An income statement reports the profitability of a business. It is your revenues minus your expenses. You will also hear it referred to as a profit and loss, but if you're taking the computerized accounting class, you'll see in that class they talk about the income statement as profit and loss, but it is an income statement. And our income statement is a snapshot in time. What we care about is what our revenues and expenses were for a particular period. It could be a month, it could be a quarter, it could be a year. It's probably not going to be longer than a year because we really want to focus on looking at trends. We don't want to have one long, we don't really care how much we've earned since the beginning of our business, since day one. What we want to look at is our income in snapshots. And so we're going to have title for our income statement here as it shows. And then there will be columns. We'll have our accounts listed here down the left, and then, well, you'll see in a second, our total columns. So we start with our revenues, and we had total revenues, if you remember from the prior videos, we'll have a dollar sign for the very first one in the top of the column. Then we're going to skip and we're going to have our expenses. So we've got kind of the overarching heading for each of these. We've got revenues, and in this case, we only have one kind of revenue. If our business did different kinds of things, then we might have different kinds of revenue listed here. And then our expenses, we've got the heading here, and then under that, we're going to list the individual expenses. Then we'll total them up. And so we're going to list those in the sort of the closer column to the descriptions, the subtotals. Then we're going to put a line under the subtotals, and the total is going to go in the further right-hand column under our revenue. And then we're going to subtract our expenses from our revenue, and we're going to show our net income. And so in its very purest and simplest form, this is an income statement. When we total up a column, we're going to put a double underline underneath it, and that shows it's the sum total. Now we're going to look at owner's equity. Now, before I go on to the owner's equity, we prepare these statements in a particular order. So the order that they're being presented to you here has some significance. And so the reason that we do the income statement first is that now, as we're looking at the statement of owner's equity, net income is part of owner's equity. So we need that net income figure to do our statement of owner's equity. So we start with Mr. Rohan's capital investment as it was at the beginning of the period, which is $2,000. We add the net income from our balance sheet. So we're not going to show we're not going to show the revenue minus all of the expenses here. We're just going to take the net income figure off of our income statement and plunk it right here into our statement of owner's equity, and then give it its appropriate title here. We can't forget that Mr. Rohan took some money out during this period. So we're going to subtract that from the net income, and we're going to subtotal it down here. So basically, what we're going to do, and this slide doesn't show it, but the 2000 that we started with, his equity position increased overall by $1,100 as a result of the net income of $1,250 minus the money he took out. So his overall equity position has now improved by $1,100 this accounting period. And so now we get to our balance sheet. And again, you'll see that we're now going to take the owner's equity figure and confirm that we're correct in terms of our accounting equation. And so our balance sheet, this is unlike the income statement, which is a snapshot in time. The balance sheet is actually, it runs cumulatively from the beginning of our business in time and shows where we're at this point. So it is now where we are at as of this particular day as a result of all of the transactions that have occurred in our business. And that's something that the sooner you can memorize those differences, the easier this will be. That's something that I think is challenging for people to remember, is that the income statement is just from maybe beginning of the month to the end of the month, or beginning of the year to the end of the year, whereas the balance sheet is the sum totals of all of our transactions over the period since we have owned the business. And you see we have our accounting equation here just in statement form. We've got our assets listed out here, and they total $4,900. Our liabilities, if you remember from the end of our lecture video on the liabilities, we still owed $1,800 in delivery equipment that we hadn't paid for. We then have Rohan Maxon's equity account, which we figured out, and it all meshes. This is our double check. Because when we add the $1,800 in liabilities to this owner's equity figure, it matches what is on the asset side. So if you imagine a big equal sign between where this big long column is in the middle, we've got our assets equals the total of our liabilities and owner's equity. So again, liabilities here, owner's equity here, the two of those are added together and they match the assets, and yay, we balance. And if we don't, we've got a problem, and we've got to go back and figure out why we have a problem. But we do not put out financial statements where we do not balance. So we're going to just kind of summarize and look at the 3 basic steps to the accounting process. And these consist of input, processing, and output. Our input is the transactions that we did. It's the expenses we paid, the services we sold, the bills we paid, the liabilities that we incurred and maybe paid, customers who paid us. Those are all the transactions. That's the input. The process is then how we categorize those transactions into usable format. We basically translate the transactions into accounting language that becomes something that is understandable by anybody who understands accounting. So, and then we use those transactions to then create financial statements. And these financial statements are consistent with generally accepted accounting principles. And anyone who understands generally accepted accounting principles will look at these and they will be able to interpret these. And they won't have to wonder what's really behind these numbers, because as long as we prepare them consistently with GAAP accounting, they will know what accounts and what numbers come together to create these statements. And so just to recap, our balance sheet is going to show our assets, which equal our liabilities, plus our owner's equity. It's chapter 2.